In this week's video, we'll review the latest charts and studies to help us answer the question, is the bear market over, or is the rally doomed to fail near the S&P 500's 200-day moving average? This week's video is being recorded on Friday, August 19th at approximately 1 p.m. Eastern Time, when the S&P 500 was down 43 points. All three of these charts show the S&P 500, their daily charts. This is the 200-day simple moving average on all three charts. The 2022 case over here on the left side of the screen, how concerning is it that the S&P 500 is currently stalled below a downward sloping 200-day moving average? Does that mean we're in a situation like this in May of 2008 where really bad things happened? Or could we be right here in the year 2000, here in 2001, here in 2001, here in 2001, or even here in 2002 before the final low that occurred in October of 2002, which is not shown on this chart? Is it more likely that we're within the context of an ongoing bear market, or is it more likely that the final low is in place? We've been asking these questions in recent weeks, and we'll continue to do so this week. And since we're using a weight of the evidence approach to address those questions, the weight of the evidence tends to build over time. Thus, it's important to understand what happened back in June, with this being the title slide from the June 24th video. And in that video, we noted that the decline that we had seen year to date, which was a 24% decline from peak to trough in the S&P 500, historically, that was a large decline. And going back to 1950, just using this in isolation, it said there's probably about a 75% probability that the bear market was over, or at least close to being over. And at that point, that simply told us to keep an open mind about better than expected outcomes. Nothing more, nothing less. All of these slides were covered on June 24th in the June 24th video. The NASDAQ tried to make a stand at a relatively important area, shown here again, and made a new relative high relative to the S&P 500. It was impressive that we cleared these gaps, and we're trying to make a stand in a logical volume by price region. This data just helps us keep an open mind, but there's nothing particularly bullish about it. And this data tells us that we're oversold in an extremely rare way, and in a manner that typically was followed by gains relatively soon thereafter, with maybe one exception here. Again, nothing bullish on this chart dated June 23rd, covered on June 24th, but it told us to keep an open mind about some type of breath thrust occurring. On June 24th, the NASDAQ was trying to make a stand at a logical level, an upward sloping 200-week moving average. And when we compared the present day to this gap here, this gap in here, and this gap here, we could make an argument, and did make an argument on June 24th, that this, going into this gap here in the weekly chart, really looked more like the 2009 low relative to these bearish cases. Here were 4 additional keep an open mind charts that we covered on June 24th. Interest rates had calmed down a little bit. Commodities had pulled back a little bit. QQQ relative to energy had shown some strength. And a lot of the issues that had been beaten up the most during the bear market, including ARKK, were showing some impressive relative strength. And if you go back and watch the June 24th video, the message was not lopsided and bullish. It was simply, there are some things that we're seeing here that tell us to keep an open mind about the market attempting to form a bottom. Really not much more than that. On June 24th, Amazon was trying to make a stand near a logical level, and we had seen enough at that point to begin implementing a very conservative accumulation strategy, thinking that even if the market didn't hold here, there was a decent probability that it could hold somewhere between this level here and this level here. Both June 24th, some good things on the chart of small caps, and a failed breakout on the chart of SH, or shorting SPY. Some subtle differences starting to pop up on June 24th. Some significantly beat up ETFs like XBI trying to make a stand near logical areas. QQQ Gold trying to make a bounce at a logical area. Growth versus the S&P 500 trying to bounce near a logical area. Again, June 24th. And I believe we noted on June 24th using this chart that you could have made an argument at that time that XLK divided by SPY, this was really the most impressive look or encouraging look that we had seen really year to date. And the summary slide echoed what we've really already said. A lot of things still to worry about in late June, but there were some encouraging signs. These charts from late June, covered on June 24th, are relevant in mid to late August because they speak to the weight of the evidence evolving over time. We're looking for things like this. We just don't have them back in late June. Thus, walking forward from Friday, June 24th, we're looking for additional evidence supporting a shift in risk appetite. So let's fast forward to July 22nd. Chart on your screen is dated July 22nd at 11:44 a.m., and this is our first thrust look that we've been waiting for. Not just lines on a page, it speaks to all of this up here. It's one signal. It's not a lot of evidence that we have in hand on July 22nd, but historically, good things happened, and the drawdowns weren't great, but they weren't disastrous either. So the takeaway was we still have all of this, but we need to see more, and we should be open to seeing things that look like this walking forward. So when we move forward from July 22nd to July 29th, we were hoping that we would see additional signals, and we did. These are all slides from the July 29th video. You can pause your video player. This is a bullish setup that was nailed down that week. The drawdowns were relatively muted, starting to look a little bit better. And the type of looks that we didn't have back in June, we were starting to see them. That's that thrust look that we're looking for. That type of look had occurred after major lows with very satisfying performance. More evidence on July 29th. We started to see a lot more never seen this before charts in 2022. In the past, when you had a look like this or a look like this, good things tended to happen. This is dated July 29th. But on July 29th, there were still things that we needed to see. Fast forward to August 5th. In the weekly video, we covered a wide array of this looks like a bottom type charts. Satisfying performance for both the S&P 500 and the NASDAQ 100 in the historical cases. And on August 5th, instead of just having one or two signals telling us to keep an open mind, we had 14 that we covered. So on July 22nd, basically said we're looking for something like this walking forward, and we did get it. Covered numerous signal dates here. Historically, really good things tended to happen in the S&P 500 index. And the drawdowns were improving, but you can see here some of them still concerning, telling us to keep an open mind about significant backtracking. So from August 5th, what we really like to see is we'd like to see this data start to improve, the drawdown data. So this is August 5th. As you would expect during a bottoming process on August 12th, we covered 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 additional breadth thrust signals, and the drawdowns, they did improve. Average and median return looking out 1 year, very attractive. 2 years, extremely attractive. Price action, also constructive. Now let's link back to the concern about the 200-day moving average and explore those legitimate concerns using a weight of the evidence approach. In the August 5th, 2022 video, we covered 60 signal dates based on 14 separate studies. Fair question. How many of those signals occurred during the 2000 to 2002 bear market or the 2007 to 2009 bear market? Answer: 1. That signal date was January 2nd, 2009. Second question, did any of the signals occur after the major lows were in place in October 2002 and March 2009? Answer, yes. Out of these 60 signals that we covered, 19 of them were flashed after the major lows were in place. So 95% of the data that we had in hand back on August 5th, looking at these studies, said the low was in place and really didn't align with this concern here or this period here. There's no signals that occur between March of 2008 and May of 2008, and we don't have any signals that occur in this window here. The only quote-unquote bad signal that we had, again, was January 2nd, 2009. But that was as of August 5th, so let's ask and answer another question. Has anything changed since August 5th relative to this one bad signal? First, it might be helpful to know, what was that signal based on? Which indicator? Was the signal based on S&P 500 stocks greater than their 50-day moving average? You can see after that the drawdown was significant, 25.27%. But that was as of August 5th based on this indicator. So here's a chart of that indicator as of August 5th, and you can see the level here where the green line is. You can't eliminate that late 2008, early 2009 case that has this large drawdown. But again, that's August 5th. And here is the chart as of August 5th. To eliminate it, you would need the indicator in the present day to exceed this level, because then you would look more like the period after the major low was in place. Well, we could do that on August 11th. Here's the reading on August 11th. We're all the way up here where the green line is. That's well above this level here. In fact, now we're meshing up with the level that occurred after the major low was in place. And better yet, if you fast forward one day from the 11th to the 12th, we went over 90%. And remember, that was Dean's threshold that said a surge above 90 would most likely mark the end of the current bear market. So for the most part, this one bad case has been eliminated based on something that's occurred after August 5th. The market has been strong enough to really erase this concern as far as history goes. So these were the questions based on the August 5th studies. What about the August 12th studies? In the August 12th, 2022 video, we covered 61 signal dates based on 12 separate studies. So let's ask again. How many of those signals occurred during the 2000 to 2002 bear market or the 2007 to 2009 bear market? Answer, 0. None of them. Second question, did any of the signals occur after the major lows were in place in October 2002 and or March 2009? Answer, yes. 23 of the signals were flashed after the major lows were in place. Here are the dates over here. Every single one of them comes after the end of this bear market and after the major low was in place on March 9th, 2009. Thus, we have a mountain of evidence in hand that really says this move from point A to point B really doesn't look anything like this move from point A to point B, or really any of these moves from point A to point B. And remember, this data is not just a bunch of lines on a page. All of it speaks to human behavior, that battle between risk aversion and the tolerance to accept risk. It speaks to the net aggregate opinion about future economic and market outcomes. It speaks to the net aggregate opinion regarding liquidity risk and the potential for counterparty risk, and you name it, it speaks to it. If you can think of it, the market has thought of it. So what else does the observable evidence, data that we have in hand between point A and point B, tell us about the probability of good things happening relative to the probability of bad things happening? The data doesn't really seem to align with this period or this period, and it seems to align very, very favorably with major lows in the stock market historically. And maybe more importantly, the drawdowns based on these 12 studies, relatively muted. 72% of the cases, the drawdown from the signal date was less than 6%. Now, during Friday's session, the market's down, but that's what these drawdowns are about. If we felt like the market was going to go straight up, we wouldn't even cover any of this. So this would be your historical risk, with 94, 93% of the cases saying the low is in. And this would be your historical reward looking out 1 year and 2 years. 2 years later, 100% of the cases the market was positive. 1 year later, about 98% of the cases the market was positive. So now we're up to 2:47 p.m. Eastern Time on Friday, August 19th, with the S&P down 55 points. The level, 42.28. Remember that, 42.28. Now, if from a probability perspective you're going to embrace this data here and or this data here, then you also have to embrace this data here. This is the average and median drawdown for those cases, the 61 signals based on the studies that we covered on August 12th. Have we done anything to violate this line or this line? No, we just looked at the market. We're at 42.28. We're up here, above this level here. So from a probability perspective, just using the average and median case, if we backtracked to here or here, that would pretty much be in line with all of this. If we look at a little bit more detail outside of the average and median historical drawdown, these are the shallowest cases, cases 1 through 20 out of the 61. You can see you'd come back hypothetically somewhere underneath, let's say, 4,200. So we were at 42.28. Nothing abnormal relative to these 20 cases yet. Cases 21 through 40, hypothetically, let's say you'd backtrack somewhere between, let's say, 41.70-ish here, and let's call it 40.25-ish here. So based on where we are during Friday's session, we're still up here somewhere in this area here. How about the worst cases? Even out of the worst cases, only 2 of them out of the 61 historically, hypothetically, if we followed a similar path, would take out this closing low from June of this year. Even looking at the worst cases, 41 to 61, the average and median drawdown comes down to about 3,800. So the moral of the story is, history says drawdown is not synonymous with straight up. As always, this isn't a forecast that we're going to come back to any of these levels, nor is it a forecast that the average and median drawdown from a historical perspective would hold in the present day. These are simply probabilistic reference points, and so far, we really haven't seen anything that discounts any of this, or anything that says the present day looks a lot like this move here from A to B in Q1 of '08, or that the present day looks a lot like this period in here. Since we are using that weight of the evidence approach, is there anything else, any other data sets? Let's link back to Dean's thoughts on this issue here. A sentiment trader provides a ton of useful data. We're not going to share all that data. That's their data. But we will make a few points about Dean's work. So this was the before it's happened post from July 12th from Dean. He basically said, today, on July 12th, the percentage of stocks above their 50-day moving average for the S&P 500 was down at 27%. If we saw a surge above 90%, historically, that would most likely mark the end of the current bear market. And we did indeed take out that level. So in Dean's research, dating back to 1942, there were 12 first signals that occurred after a bear market. So that would be similar to the present day. 2022, this is the first time we've seen a surge above 90%. In the historical cases, when you had the first surge after a bear market, the market's gain, the average gain a year later was 25.57%. The median gain was 25.6%. 100% of the cases were positive. So once again, if you're going to embrace this, 100% of the cases were positive, and that historically the market returned an additional 25% looking out 1 year, then you also have to embrace the volatility that comes along with those historical signals. It wasn't necessarily a picnic in every case walking forward. The average drawdown, almost 3%, the median drawdown, a little under 2%, 7% in this case, and over 11% in the 1947 case. And since we know the date of the signal in the present day, We can put those historical drawdowns on a 2020 chart. Remember, we just said the market was trading at 42.28, which basically says we haven't seen anything yet. We could fall all the way down here to 3,800, and this signal, from a historical perspective, would still be intact. So if we're going to embrace this or this, the median return, then we also have to embrace this. And thus far, we haven't seen anything yet that's overly alarming. It's not a prediction in any shape, form, or fashion. Talking about the chart in front of us. It's very, very easy to see green like this down here and forget about 100% normal and to be expected volatility that occurs even within the context of a post-major low market. It can be helpful to use a reliable source to check your work. August 17th. S&P 500 winning streak is another bear killer. This is basically a rarely oversold reading with price to a rarely overbought reading. There's been 9 signals since 1950. The average one-year S&P 500 gain was 17.51%, with 100% of the cases posting positive returns a year later. And if you're going to embrace this signal that Dean covered, you also have to embrace the volatility that goes along with it. Drawdown is not synonymous with straight up. Average drawdown 2.5%. It occurred over 32 calendar days. Based on these signals here, the median drawdown 2.7% in 7 calendar days. So let's tie Dean's signals back to this topic. If we're concerned about this look here from Q1 2008, then that means in the present day the bear market would not be over. Similar situation here. If you're concerned about this period here, the year 2000 out to about mid-year of 2002, then the bear market in this instance and in this instance here is not over. So this is the first Dean signal that we covered based on the percentage of stocks above the S&P 500's 50-day moving average. Notice in this data set here, in recent history, there's been 3 major bear markets, 1973, 1974, 2000 to 2002, and the financial crisis 2007 to 2009. The only dates that are tied to those periods in Dean's table, all 3 of them occurred after the major low, after the major low, after the major low. And you can tell by these average and median drawdowns that these cases really aren't alone. Typically, when you see a signal like this, the worst is behind you, at least from a historical perspective. It doesn't predict anything in the present day. It helps us assess odds. Nothing more, nothing less. How about Dean's second signal based on the S&P 500's winning streak? There's 3 dates, 3 signals in this table associated with those major declines. This is the 73-74 bear market. This is the dot-com bust bear market. This is the financial crisis bear market. All 3 of these signals, the only ones associated with those periods, came after the major lows, after the low was in. It didn't mean volatility was behind us. There's still some volatility, but the low was in these historical cases. So now it's a little bit after 3 p.m. on Friday, August 19th, and the S&P 500 is trading at 42.21. Where's 42.21 on here? It's right here. So once again, if you're going to embrace this signal and these returns, 17.51% on average looking out 1 year with 100% of the cases positive, you also have to be willing to embrace this historical volatility. In terms of these cases here, the S&P 500 could backtrack all the way to about 4060 or so and still remain within these bounds shown on your screen. After this, good things happen because we know the drawdown wasn't that significant and we know the average gain was favorable. In the historical cases, if you were able to withstand this volatility, good things typically happened. Thus, to summarize, the fact that we're always talking about drawdowns, that acknowledges real-world volatility, something that we're experiencing during Friday's session. The weight of the evidence says the low is most likely in place. As always, the allocations that we currently have in place and the statements that we've made in this week's video, They're based on the facts that we have in hand today. The concept of odds, it's significantly different from certainty. 95% is not equal to 100%. This is nothing new here. We'll wake up Monday morning with no assumptions about what the rest of the week is going to look like. Make no assumptions regarding any topic: Fed policy, earnings, inflation, the economy, the labor market. No assumptions regarding any time frame. The markets are aware of all the issues that we're aware of. We're all concerned about inflation. We're all concerned about the Fed. We're all concerned about the economy. And yet, all of those signals have been generated. Those are facts. They're not erased by 1 or 2 days of volatility. And maximum flexibility means we're not tied to any of this. If the data shifts, then we have to be willing to reassess the odds. Today's news and today's analysis is a sunk cost. It's yesterday's news. Have to reassess with an open mind every day walking forward and remain open to a wide range of outcomes. There's a lot of uncertainty relative to Fed policy and inflation, and thus we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.